So what you're basically asking me is, how do you break down a profit and loss statement? Is that what you're asking? And how you read it, right? Okay. So one of the things that is, obviously part of owning a business is being able to report profit and loss to the IRS. That's a very important part. And in that, it also gives you the capability of looking at how you're doing along the way. And in a profit and loss statement, you have revenue, right? So whatever your product or service is, this captures how much of you sold of your product, how much you sold of your service, whatever it may be. And that's captured on the top line. That's first. Then you have things called direct costs. Now, direct costs are really things that you buy, you sell, but in between that, you actually add margin to. So the three most common ones are going to be material, labor, and subcontract. Okay? So any business I've ever walked into, they've either been material intensive, they've been labor intensive, they've been subcontract intensive, or a combination of two or three of these. So in this example, what I'm just going to do is I'm going to go through as if you actually had all three in your type of business or service, whatever you provide. So you buy material, you then add some sort of margin. Let's assume that in this particular case, you mark all your material up 30%. You have labor, you pay them an hourly wage in most cases, and then you sell them for an hourly wage. And then you have subcontract, and subcontract, what you do is you have their contract, whatever they said, will perform this service that we don't self-perform. And what we're going to do is we're going to mark that up as well. And all of that math, all of that equation, whether you're the author of it or whether it's been handed down to you year after year after year, all of that accumulates a certain amount of revenue, right? So I bought material, I added margin, labor added margin, subcontract added margin, and that comes up with your final price. So when you look at a profit and loss statement, the accumulation of revenue is going to be based off of all the products or services you sold at your price. But what you want to know is how you actually make a profit, because that's really what you're asking me, I'm assuming. When you've done all of this equation, the combination of the actual costs of this are called cost of goods sold. Okay, so costs of goods sold are how much did I pay for material, labor, and subcontract, and what was my recipe in my price. So let's assume, just for quick math, that your cost of goods sold is 75%, which means in order to sell your product for $1 hypothetically, a combination of material, labor, and subcontract adds up to 75 cents. That would mean that your gross margin, or what's left over, is 25%. That's based on how you priced your product, okay? So that's what would be left over. Now down here are all the other costs in your business. You could give an example of marketing, that would be one. It could be admin employees, that could be two. It's really the internal infrastructure. So it's literally every other cost that you have in your business is recorded down here. Now, if we're looking at how they're defined under accounting, it would be things called semi-variable costs and general administrative. I like to sum it up and just say it's all your overhead. So this over here is all your overhead. And you kind of have to look at it as a bucket. And that bucket, I don't like to look at it as a percentage. I like to look at it as dollars. So how many dollars is it going to take to fill this bucket? In this example, we're going to assume for a second that it takes $500,000 to fill that bucket. So when you take this business, this made-up business over here, what we know so far is based on how they price their product and how much it takes to support the selling of their product, is we have 25 cents out of every dollar comes down to fill up the bucket, and we have a $500,000 bucket to fill. So in this particular company, when I'm looking at their profit and loss statement, I would have to determine, in order to break even, what does this business have to do? Well, in this particular case, the $500,000 bucket being filled up by 25 cents, I would need to do $2 million worth of business just to make zero profit, just to cover all costs. That's all I would have to do. So The only way that happens though, and this is the most interesting part, is I would always have to make sure that I control my material, right? Material, I'd have to make sure that I control my waste. I'd have to make sure I control my theft. I'd have to control my damage to my material. Because if I lose some of that material based on waste, theft, or damage, then the issue becomes I have to buy more, but I can't add margin to it. Because I can't, in other words, if something takes 5 pieces and I ruin 2 of those pieces, and I have to buy 2 more pieces to make the 5 of the product I have, I've now bought 7 pieces of material to make 5 of my product. What does that do? It drives this number down because it now costs me more. Let's say it's 2 cents. So that's why material control, when you're looking at a business, you got to make sure you control your material, because if you have to buy 7 to make 5, that's going to drive this cost of goods sold up, and as a result, it drives your gross margin down. Now, if we just had that happen and that happen only, the issue is the $500,000 bucket still has to be full, but I don't have 25 cents anymore. I might only have 24, which means this number, in other words, my break-even sales volume, it grows. So it's very important that when you're reading a profit and loss statement, you not only know what you're starting out with in terms of your gross margin, but you also have to know that every time there is some sort of mismanagement of material, labor, or subcontract, it drives up your cost of goods sold and drives down your gross margin. And if this bucket, assuming it stays the same at all times, if this bucket is 500,000, it's telling me that I'm going to have to do more sales to fill up a $500,000 bucket because I don't have the 25 cents anymore. So it's very important that when you look at how you control the outcome of the game, is that you always, as a business owner, get to be able to see your gross margin at all times. Now in accounting, when you're looking at it, here's one of the most common things I do. I'll ask a business owner, what is your gross margin? And what they will tell me is what they saw on the profit and loss statement last year or last month or whatever it may be. And the most common question is then, is that what your pricing formula, in other words, this formula of buying, adding margin, and selling, is that what you intended to make? They look puzzled in most cases. The confident ones obviously say yes, but we're always going to check that. And how we're going to check that is actually go through by taking all the costs they've had over a set period of time and multiply them by whatever margin they've added. And if that adds up and equals 25%, I feel safe, I can move on. But if it doesn't, then we have an area of concentration, which means somehow my waste, theft, damage in my material is not being controlled, my labor productivity is not being controlled, maybe my change order system as it relates to subcontract is not being controlled. Those are all major points that actually have an impact on the number. So when somebody says, what's the most important number that I look at when I look at a profit and loss statement, it's actually gross margin. It has the biggest impact overall. Because if I grow my revenue, right? If I grow my revenue, but this number drops, then I really may not have moved in any way. In other words, if my revenue goes up to 2.2 million, but the lack of control over my direct costs results in this dropping down to 20, that's a big issue. I really haven't moved. I've actually gone backwards in most cases. So revenue isn't the most important number. Gross margin to me is one of the most important numbers overall in the control you have over it. So how do you have control? I got to be able to look at these direct costs, and I have to have 4 specific things in place for each one of them. And these 4 specific things give me the most amount of control. Number 1, I have to have a standard. Okay, so what's a standard? A standard says that out of $1, since there's only 100 cents in $1, that's all there is, out of $1, how much is material supposed to cost me? So in other words, is material supposed to be 35 cents? Let's just say that as an example. Is that how much material is supposed to cost me? So if I don't have that standard, if I don't know that out of $1, material is supposed to cost me 35 cents, then the other control points that are listed, and we'll go through them in a second, then they don't matter because I don't know that I'm starting with 35 cents. So if I move to the next one, which happens to be measurement, I have to be able to measure that it's only costing me 35 cents for material. But if I don't know it's supposed to be 35 cents, that's the big issue. So the second standard is measurement, and I have to measure against the standard. The next area of control is any type of operational control I put in place, any type of operational control. So again, if we're just concentrating on material as one of the examples, as the first direct cost that we're looking at, control to me, or operational control, would obviously be looking at the waste factor, right? How do I control waste? How do I control theft? Well, theft might be that I put a fence around my inventory that's in the backyard. I might put a camera. I might put something. Those are operational controls to make sure that I don't have to replace the material in order to actually perform my service or product or whatever it may be. Those are operational controls. And the last part, to have ultimate control, but more control from a standpoint of as a business owner, is I've got to be able to come and go as I please and allow my business to control that cost, or someone to control that cost for me. Or while I'm not present, that they are constantly in a position to even drive that number down further. In other words, let it only cost me 34 cents or 33 cents. And the only way that's going to happen is if somebody takes ownership over that. They actually take ownership over the control of that cost for me. Now, people have tried numerous incentive programs. Usually, they say they failed. And usually the most common reason why they failed is two reasons. Number one, they didn't have a standard in the first place. So if they don't know they're starting with 35 cents, that's what it's supposed to cost me, then the issue becomes, what am I going to incentivize? Well, incentives are supposed to be excess based. In other words, more profit has been created, and as a result of more profit being created, I can now share it with the employee that actually created it for me. So if I don't know that I'm starting with 35 because I don't have a standard, then how am I going to set up or understand if I've created access based? People feel very comfortable doing with salesperson. I had this much sales, they sold more, I can actually pay them more commission. That's an incentive, right? But when it comes to material control, somebody controlling my waste, somebody controlling my theft, somebody controlling my damage, those are all important factors that will result in maintaining that standard for me. But moreover, when they buy and how they buy. If we're buying things last minute, if we're buying material for a job last minute, we're going to pay a premium. That's going to drive that cost up. So there's a lot of incentive programs I can put in front of people to control my material costs to make sure that the outcome of the game is that it's at least 35 cents, but I can incentivize them to try to drive that number down. When we look at labor, labor is a big one. Labor productivity is a monster issue. I hate to say it, and probably there's a few people in this room, but the average labor productivity, the average labor productivity that I have found when I'm analyzing companies over the last 25 years, and that's about 88,000 businesses at this point, the average labor productivity is about 62%. Yeah, it's a shocking number. Not a lot of people will actually believe that number. There's no way that I'm only getting 62%, because what that means is I pay my laborer for 40 hours, right? 40 hours for the week. And what I'm getting back from them is about 24 to 25 hours in return. In other words, what they produce for me is about 25 hours. So most people, when I ask them that question or even comment that 62 is the most common, they say there's no way that I'm even close to that. So I ask the question, what standard have you set forth in terms of labor productivity? How do you measure it? What operational controls do you have in place? And last but not least, what incentives do you have in place? Most common thing they go to is they go, I've got an incentive. I give them bonuses at the end of the year. Or, I give them overtime. And overtime is one of my favorite answers. So what you're saying is you incentivize your employees to work slower so that when you finally say, we got to get this job done and we got to get it done quickly, what they do is now get to work Saturday and they earn time and a half. So in other words, when you look at overtime, it's an incentive to work slower. The other aspect that we have to look about in the incentives is these Christmas bonuses or quarterly bonuses or year-end bonuses, whatever it may be, is I always ask, okay, what is that, if I'm the employee, other than it's coming at Christmas time and I'm probably going to want to be in your favor, can I calculate how much that's going to be? Like, what is my Christmas bonuses going to be? I'm assuming it's going to be as much as last year. I'm assuming it's going to be in terms of maybe a little bit more. But that's an assumption. Is it related to the business performance in any way? Is it related to what I've done overall? Can I actually figure out that my performance had an impact overall? And most common, the answer is no. Christmas bonuses, year-end bonuses, quarterly bonuses, unless they're driven from some sort of standard that I have a personal impact on as the employee, I will just see it as an expectation. I will not see it as an incentive. And so when you think you're taking care of your people, what you're actually teaching them is how to treat you. And how they treat you is whenever that bonus is going to be coming up, again, if it's the year end, around November, I'm going to look like the employee of the month because I'm excited about what it is that I'm going to get out of you, but I don't really know what it's going to be because there's no calculation as it relates. So incentive programs, to me, they actually really, really work, but the first three ingredients have to be present. So when we go over here and we have a look at what a profit and loss statement is and how you read it, it is how you get your product or service, looking at its direct costs and figuring out, based on what your market will bear, what your pricing model dictates is your intended gross margin. And your job as business owners, your job as founders, your job as general managers, one of the primary jobs is for you to control and maintain whatever you've put into your pricing model. And the problem I have is in most companies I walk into, all I have to do is look at them and say, tell me what standards you have in place for each of those direct costs. Show me how you measure it proactively. In other words, during the month or during the week or during the job, how do you measure proactively against the standard? Show me the systems, controls, and methods you have in place to control the operations. In other words, control waste, theft, damage, control labor productivity. With subcontracting, control that, have a good change order system that makes sure my margin is added to each one. That control is very important. And last but not least is, do you have incentives? Do you have your people actively looking at how they can control that cost for you, whether you're there or you're not? And will they drive that number down because will they know that it lines their own pockets, and it lines their own pockets on an immediate basis? In other words, we're not waiting till the end of the year. They know on a project-by-project basis or a week-by-week basis or whatever it may be, the time structure that it needs to be, that I'm actually creating more profit for myself as an employee because I can drive this cost down. So if you have those standards, measurements, controls, and incentive place, the chances of you controlling your gross margin are about 9 million % higher. Exaggerated number, and that is obviously one of the biggest controls you have to do as a business owner. Down here on the overhead side, it comes down to budgeting and controlling. The reason why I say you have to budget and control this side and why it's super important is because right now, if we go back to the original equation, I know I have to do $2 million if I control my gross margin to be 25% to help me fill up a $500,000 bucket. But if I don't have a control over each one of these line items, everything below the gross margin line, then this will creep as well. And if it creeps, then what's the target? What bucket or what size of bucket am I having to fill? So when I walk into a lot of business owners and I look at their profit and loss statement, the first thing I want to know is what they're doing to make sure they understand three major factors. What's their gross margin? How much is their overhead bucket? And last but not least, whether there's a break-even sales volume. Most people will answer, they'll guess, they'll give me an indication, sometimes based off of ego, but never by design. Nobody can actually show me in terms of on their internal reports that their pricing model is this, so as a result their gross margin is this. Sometimes they can show me an estimated budget in terms of overhead, but when I ask the number, what is their break-even sales volume, the guesstimations aren't mathematical. They're gut feel in some way. And when I say gut feel, it's not like they came up with $1.8 million. they usually reference how much they think their overhead is every month. That's the most common answer that I get in terms of what their break-even sales volume is. So when you're reading a profit and loss statement, know that there are some things that are very important, but knowing each area of this as a business owner is extremely important, because the only way that you're ever going to make the P word, right, profit, is because I've controlled my direct costs to produce a gross margin. I controlled my overhead to be $500,000. I got to my break-even sale, and only when I get to my break-even sale before the end of the calendar year, every dollar I sell after $2 million, if all this held true, now becomes my profit. In other words, the gross margin of every dollar after $2 million, the 25% is how much I make in terms of profit that time. Why? I've covered all of these costs. I still have to, at 2 million or 2.2 million, let's say the $200,000 after 2 million, the $200,000 will still pay me 25%, but I've covered my overhead and now I make a profit. So, reading a profit and loss statement, there's some important factors, but the three main are going to be, again, not to be redundant, gross margin, learn what it is, control it, overhead, budget and control it, break-even sales volume, know what it is and hit it, and only then you'll make a profit. Does that answer your question? Thanks.